Learn Accounting Podcast by Professor Accounting. This is episode 12, Calculating Provision for Doubtful Debts Pro Forma. So I've put together the typical pro forma for calculating PDD. Now this is typically what I use for OCR examinations to teach students, and obviously I adapt it when it's for AQA questions. It's a very good theory. So let's start off with debtors. So just make up some numbers. Let's look at debtors of £22,000. And this value we get from obviously in the question, but whereabouts it would be in the trial balance or in a list of balances. Now the debtor value there would have taken into consideration any bad debts that have been written off during the year. Because naturally, when a bad debt is declared, it has to be prudent, to be cautious, and to not overstate assets. Debtors have to be reduced in the ledgers. So that takes into consideration bad debts. However, towards the end of the financial year, which is the time now when we calculate in PDD, there may be some extra bad debts, some bad debts that have just occurred, but they haven't been written off in the ledger yet. So you need to take them into consideration. So let's say bad debts are £1,800. So we get new debtors, which is bad debts away from debtors. The next stage is to do specific provision. Now this is unique to OCR. AQA don't examine specific provision. They don't go into too much detail. What is specific provision? This is a particular amount of money that a business believes has a higher degree of probability that is unlikely to be paid on time or to come into the business. So it's all about probability and levels of risk. So if we are pinpointing, which is what specific provision does, it pinpoints specific debtors, certain debtors, and certain amounts of money from those debtors. So it doesn't necessarily have to be the whole amount from debtor. It can be certain parts of what a debtor owes the business. This is taken into consideration next. So let's say we've got £1,500. The remaining debtors is the value taken away from, so specific provision taken away from new debtors to get remaining. The next step is to look at the general provision, which is in all examinations for accounting, and I've just used a value for 5%, quite a common value, but somewhere around 5% typically is accepted. So 5% of the remaining gives you 935. Take that away from the remaining, and you then get the final debtor value, which is going to belong into the balance sheet of 17,765. We'll come onto the balance sheet in a moment with an extract with that value, but the most important thing is to look at this calculation. We've just calculated via this method specific provision and general provision. So we add them together to get new provision. So it's the combination of both. So new provision now is 2435. And key information about this new provision. This new provision, where does it go? Where does it belong? This is a balance sheet item. It does not go in the profit and loss account. Something else goes in the profit and loss account, not the actual new provision. So it's a balance sheet item, and it reduces debtors. So it's taken away from debtors, which I'll show you in the extract below. So we've got this term called new provision, and because it's using the word new, or I'm using the word new, it doesn't really refer to that in the exam. It just says calculate the provision for doubtful debts, and it gives you a date. So if it's the most recent date coming up, or the recent end of the financial year, then that means it's the new provision. So if you've got new provision, the chances we may have some old provision or existing provision. So we've got a few different terms that we can look at: old provision or existing provision. So let's say, for argument's sake, existing provision was £1,200. What we now do is we move on to the profit and loss account, and we record a change in provision. So we've already worked out the 2435 is the actual new provision. It's the balance of provision. But we need to compare the new provision with, in terms of what was it last year, if anything, it could be zero, and then what is it this year, and then reflect the change in the P&L. So we do this with this example. So old and existing is £1,200. What I get students to do is use this very useful little pro forma. Change in PDD, well, this is going to go to the P&L. It does not go to the balance sheet. New provision goes to the balance sheet. Change in PDD goes to the P&L. So the values have been entered, as you can see with formula. So the was and the now approach is typically what I use from retail, where you've got sales, promotions. It was this, is now this. So it's quite a nice approach, but you can by all means use the new and the old, or the existing and the new, whichever way you wish. But the was is £1,200 because it's existing, and it's now 2435. So from a maths point of view, you're just taking away the two numbers. So this number, and then minus, and then you want the number underneath, which will be this number. So you get, in this case, you don't get that, so £1,200. This number minus Q25, let's go up, Q23, which is 1235. So I've done that there so you get a negative value. Depending on which way you do it, was minus now or now minus was, you're going to get a positive or a negative value, but the value is going to still be 1235. So my view in this is just to ignore the sign, whatever it is, if it's a plus or positive or a minus, then just ignore it. What I care about is you've found the difference in mathematically, and then now it's a case of using logic to determine whether it's gone up or gone down, increased or decreased. So if it was £1,200 and it's now 2435, it's obviously increased. So an increase, you can just denote this. So why I'm emphasising this increase decrease? It's very important that you ascertain increase or decrease. You find that out because you need to therefore then, certainly in OCR. Maybe in AQA some questions, you need to therefore then understand where does this value now go. So it goes in the P&L, we've just clarified that, it goes in the P&L, but where does it go? Does it increase gross profit with other revenue, or does it decrease gross profit with an increase in expenses? So here is the rules, which you may know for already, or you may be learning from me for the first time. So here are the rules. If there's an increase in PDD, which is what we have in this first example, then this is classed as an expense. So we're increasing the provision. So provision is an amount of money that we are expecting not to get from debtors. So basically, if provision goes up, then our costs go up. That's the way of thinking about it. Now, it's just a provision, so debtors may actually pay the business money, which is good. That's the whole objective. But we're just trying to offset in terms of what they might pay, in terms of what they do pay. So to be prudent, to be cautious, we have to be seen to respond to any potential doubts of debtors not paying. The opposite side is a decrease in PDD, and when it's a decrease in PDD, that's a decrease of expenses. But the way we have to think of it is the effect on revenue. So a decrease in expenses is going to be an increase in revenue. So it's other revenue, and because it's an increase, it's added to gross profit. So remember the P&L, I'll show you the extract in a moment, but remember the P&L section, you've got gross profit, then you've got other revenue, and you do your totals, then your expenses, and then find your net profit. So if you've got an expense, it's decreasing net profit. If you've got a revenue, it's increasing gross profit and obviously increasing net profit. So some rules there you must master and understand. But it's a good link between always determining whether it's increased or decreased. So if you get the sign, if you rely upon the sign, as this example shows you, well, the sign is a minus. So you would naturally think that means decrease. So don't rely upon the sign, because it just totally depends upon which way you work out the change. Now minus was, or was minus now. I'll do another example shortly with just on the same screen, changing the existing, because I've done where's the decrease, because you've got existing being lower than the new. I'll change that to being higher in a moment. I'll just go on to the starting the extracts of the balance sheet. So over to the balance sheet now. Here's a structure typically asked in OCR. AQA, they can ask it. It's just there's only a certain point as to why they ask these questions, and it's just to show that you choose the correct debtor value to go into the balance sheet, and that you again choose the PD value as well. So it's just a couple of marks, but it's easy marks to get if we know how to do it. So I've just done 3 columns just to show you that when you work out PDD, you use the left column, just because the calculation, and everything else in the current assets stock will go in the middle. Any prepaid expenses, any income in arrears as well, and any bank and cash and so on and so forth would obviously go in the middle column. So it's just a side calculation here for the PDD. So let's do the easy part. The less PDD from the rules that I've mentioned, new provision is what goes in the balance sheet. Balance sheet for new provision. So we said that there, balance sheet item, it goes in the balance sheet. So this 2435 is what's going here, 2435. Now, going back to the calculations, the debtor's value for the balance sheet, well, this number has to go in there as well. Well, that is your new value. So down here I've used formula. This value currently, because there's no value in the debtors, has to be that new value. So obviously that's going to be in there. But what value goes in is the original debtors. That's the one that students do make some mistakes upon, because you've got debtors up here, new debtors, remaining debtors, and then final debtors. It can be a bit confusing. So let's just break it down. Well, you've got 2435, and that's here, and that's the 1500 and the 935. Well, that value, these values have to be taken away to get this value. So the only value that leaves is new debtors. So the new debtor value is the value that will go into the debtor box. So this is going to be that value there. And you see that it's correct because with the maths, the debtor value in the calculation, put in orange, is the correct value you've just got in the extract. So there's a connection there between your pro forma calculation and the extract in this case. So 20,200 minus 2,435 gives you the remaining balance sheet value. So quite an important element there for the extract. Some students, they just put the calculation alongside the debtors. They just do 22,000 in this case minus 1,800 just for extra marks, but you get full marks if you did that in an OCR exam with regards to showing the key information in that question, the debtors and the PDD. Looking at the TP&L, so what I'm going to do is just, before I do the TP&L, is just to give you kind of an overview of the structure. We start with gross profit. Now you could be given values in this case or not. You just may have to just use crosses just to show an illustration. Don't be too detailed. You just need to show the effect of whether it's an increase or decrease. Now currently it's an increase. Provisions increased by 1235 because of the numbers that I've used. Okay, so the rule there is it'll be an expense. So okay, where'd that go? Well, if you look at a previous podcast that I've put on there, you can see a very detailed pro forma of the income statement, the trading profit account, and you can see there the expenses, and you probably know it by now as to where it would go. What I'm going to do is just change the PDD just to show you, I suppose, a different calculation. A decrease if you wish. So gross profit, you've got here, we've got a value, we've got other revenue, other income, and then what would this be? If it's other revenue, so if it's a decrease, then you're looking for a decrease in PDD, and then you put the value over here, and then you simply show the maths. So a decrease in PDD is other income, so it's a positive value which is going to go into increased to the bottom section here. So this value X, this value there will be this gross profit plus the decrease in PD to give you a value. They tend not to give you values for the gross profit because the chances you're going to have other values like other revenue or even expenses. So they just you just have to show where this decrease will go. So why am I talking decreases? We haven't got a decrease. Let's just show a decrease. So clearly a decrease would come about if the old or existing provision was actually higher than the new provision. So let's say it's 2,600. So 2,600 is the existing. The new is 2,435, and you see this adjusted with formula in here. So the change is 165. Now just look at that for a moment. It's actually gone. It's now showing a positive value. So it's a positive value in this case because of the mass, the formula. But if it's a positive value, does that mean it's an increase? Well, it doesn't, does it, in this case? So 165 is the number. That's all I care about for not reading the sign. And then I use logic to understand whether it's a decrease. So it was 2,600, it's now 2,435, so it's got a decrease. So if it's a decrease of 165, using the rules, a decrease in PDD is other revenue. So this is useful. This is the pro forma now. This structure is what I'm using. So I have a value for gross profit or an X, and you need to be putting in either 165, or I'll just do a formula 165. And you would get obviously an adjusting, if there's a value there that would adjust, or you can work it out. A bit irrelevant, those are the numbers. It's just to show a decrease in provision for doubtful debts is an other revenue. So that's me tweaking the old and existing PDD from a lower number to a high number, and hopefully you can now see the effect of changing PDD. So I've gone through there the pro forma of calculating PDD in full. Using all the different types of provision and bad debts. I've gone through the balance sheet extract in terms of the structure. I've gone through the change in the PDD, which affects the P&L, and the P&L extract as well, from the perspective of a decrease. This is the harder one I think students find. If it was like previously an increase, you wouldn't obviously have this here. You would have just other expenses and an increase in PDD, and the value would go in, and it would obviously decrease. For it being there, it would decrease net profit. But again, you don't have gross profit to work out net profit. But you're just showing where values would go. So I've run through there of the topic. I hope you find it useful, and if you're learning this topic, or if you've been revising this topic, I hope you find it useful for revision. I want to thank you for stopping by. I'll see you again for another podcast from Professor Accounting.